appreciate the opportunity to chat with everybody today. Give everybody sort of a latest lay of the land for the auto industry. Before I get into my actual presentation, it's probably instructive. I realize that there may be folks on this call that don't know who S&P Global Mobility is. We're a business intelligence firm, I guess, at its most basic of descriptions, but solely focused on automotive in our mobility division. I've come out of our forecasting and planning area, so covering light vehicle sales, production, powertrain and propulsion trends, and providing these forecasts, model level, down to the model level and plant level, to automotive suppliers, to the automakers themselves, and also financial firms that are either investing in or lending to the auto industry. We also have a sales performance and marketing area that, think of that as the dealer support side of the mobility chain, where we're sort of matching those dealers with buyers, as it were. We use a lot of data and analytics, registrations data, loyalty data, all of that to help with hopefully consummating those transactions. Then we have a vehicles in use area. Think of that as that after the vehicle's been sold, all of the vehicles around us, vehicles out in the population. We've got a great consumer brand there in Carfax, tracking vehicle history. Really do help support the aftermarket in particular in that area. So again, once the vehicles are sold, boy, there's a whole afterlife after those vehicles are on the road, and obviously have to be supported kind of throughout their lifespan, as it were. So we're part of that cycle as well. So enough of that, get that out of the way. Let's talk a little bit about the industry and more importantly, maybe to help frame things up for folks on the call, how we forecast the industry. I mentioned just a moment ago, we track and we report model level, program level, plant level production and sales. Again, high level of detail and granularity. So there's that side of it, and that's where the rubber really hits the road in terms of the data. But boy, how do we develop that data? And that process is very much a top-down and bottom-up approach. The top-down part of it takes a look at economic data. We have economic forecasts, GDP, unemployment, inflation, interest rates, go down the list. Those data points and those fundamentals help us to formulate and set the top line demand levels, region by region, country by country, segment by segment. Then we also look at that bottom-up approach. So we take that bottom-up approach where we're looking at all sorts of different plant level trends, plant level information, investment activity, new program launches and new programs that are being planned. And we build up model by model, plant by plant in the case of production, and model by model, country by country in the case of sales. So it's really just a fascinating, it's a fascinating blend, again, of both that top-down and bottom-up. So let's talk about the top-down side, the economic side of the equation, because again, that is a big input. That's a key driver for us as we start thinking about at least setting those top-line demand levels. GDP is one that jumps right out, and this is one that I'm covering at least in this deck because it is a big driver. And what we've seen since the election last November, and then really since the announcement of tariffs back in late March, early April, we've seen some deviation, certainly some revisions to our own economic outlook and projections. But more recently, we've made some upgrades. So we made some downgrades initially when we saw particularly kind of those April tariffs. What I would come across here with you now is when I show you our September forecast for GDP versus October, we've actually been making some I would say modest upgrades. So while there are risks out there, and that's why that's kind of the subtitle text here is risks aplenty, because there could always be a tweet, there could always be kind of a breakdown in talks. Again, we're at least maybe a little bit more comfortable with how some of the economic trajectory has been playing out. Global GDP growth this year, about 2.7% with our latest October settings. Again, a little bit of an upgrade versus our September settings. Next year, we had a little bit of a downgrade, 0.1. Not significant, still quite positive, but a little bit of a step down next year. Whereas in the US, again, we have a little bit of a bump this year. We're at 2% GDP growth. Again, for a developed market like the US, that's not terrible. I mean, again, especially from where we were in that March-April timeframe where there was a lot of uncertainty around tariffs. Some of that uncertainty has ebbed a bit. You look to next year, and we made a little bit of a downward revision, but not much. We're at 2.2%. So GDP growth next year, even relative to this year, we see a little bit of incremental growth there. I only bring all that up to say that from an automotive perspective, there's still it's still somewhat supportive of both vehicle demand and certainly that resultant production, which I'll be showing in a moment some of our forecasts on that front. So again, one of many data sets and data points we look at when we think about, again, some of the macro fundamentals, macro drivers that impact and influence the auto industry. Now let's talk about the industry itself. Start the process around maybe a pulse check of where we're at currently. And this slide, I think, does help to sum some of that up pretty well. The left-hand side of the slide looks at the top 10 markets around the world. Where do we stand from a vehicle sales perspective through the first 3 quarters of the year? So again, through September, when you sort through all of the different machinations and the different players, the net result is we're not doing too bad. Through those first 3 quarters, for those top 10 markets, we're up 4%. Now, again, those top 10 markets, the two biggest markets within the top 10, China and the US, are all showing pretty constructive growth. China's up about 6%. Even in the US here, a much more developed market, we're up 4%. So again, not bad in the overall scheme of things. Certainly still a positive environment in general as it relates to the demand side of the equation. Now, for differing reasons. When you look at mainland China, we've seen growth up 6%. A good part of that has been supported by scrappage subsidies, meaning if you trade your car in, you get money back or an incentive to purchase a new vehicle. So that is driving a fair amount of sales within China itself. There's also EV incentives as well that are still out there for electric vehicle purchases. In the US, we saw a real strong sales activity in the summer months as dealers were really advertising and leaning into the whole tariff uncertainty and saying, come on in and get your pre-tariff cars, the cars that haven't been tariffed yet, get them now before the tariffs hit. We'll get into that in a moment because really the tariffs haven't hit in terms of the actual impact to vehicle pricing, interestingly enough. And again, sales have been supported that way. Once you get past those top 2 markets, it's a little bit of a mixed bag, admittedly, but there are still some key markets that are still showing some decent growth. Some of the Western European markets are a little bit mixed for sure, and that's weighing a little bit on the market, and we can certainly talk about that as well. But net on par from a sales perspective, still encouraging. Right-hand side of the slide is when we start talking about utilization. And obviously, when you start thinking about the financial performance of some of these companies, utilization is critically important. You look at a region like Japan, Korea at 82% utilization. From an automotive perspective, that's actually pretty solid, pretty strong. We kind of want to see it at 75% to 80%. 82 is a winner. But big risk there is we have the risk for more localization, meaning with tariffs in the US as an example, we could see some of those Japanese and Korean automakers looking to build more vehicles here in the US. That might weigh a little bit more on some of that utilization rate in Japan, Korea. You can see North America at about 69%, below where we want it to be. We still have some lifting to do there, some wood to chop, even in Europe as well. China's an interesting one. China's by far the largest market in the world, and you'll see that in a moment. We start running through the numbers. We're only running at 54% utilization. It's an incredibly fragmented market. So it's very much a tale of winners and losers in China, and we're still under the gun in terms of really a utilization rate perspective. We're running well below where we should be, at least from a pure utilization perspective. So not terribly healthy financially, at least from that perspective. Now this next slide, it's a very busy slide. And again, the folks at Feng have the deck and told them to absolutely please share it with everyone. I only include this, I'm not going to be reviewing it ad nauseum, but I want to give you context in terms of how we go about projecting and making our forecast. There's a lot that goes into it. And when these tariffs really kicked off in late March, early April, we had some real big decisions to make. How are we going to spread the impact of these tariffs through our forecast? And again, there are a wide variety of regions that are being impacted by these tariffs. Rightfully or wrongfully, it is what it is. Canada, Mexico. We've got a USMCA free trade agreement we've had that really spawned out of NAFTA, and we've had it for roughly 30 years. That's been really that's been the major predicate of how trade and sourcing has developed through the broader US, Canada, and Mexico markets over these last 30 years. So it's been pretty disruptive, to say the least, to now be slapping 25% tariffs on Canada and Mexico for vehicles and parts. Now, one key call out here is USMCA compliant parts are not being tariffed. That, by my estimation and our thinking, is probably the most consequential decision that helps to blunt and mitigate some of the negative impacts of these tariffs. But we are still tariffing vehicles coming in from Canada and Mexico, less the US content, so backing out US content, and non-USMCA compliant parts. Our estimation is there will be a step down in that tariff rate of 25%. The risk is we had kind of baked it in early next year. It might be tied towards sort of the renegotiation of USMCA, which really happens probably the middle part of next year. So we're still not fully out of the woods there on that end. When you start looking to Europe and Japan in particular, we've already seen the step down from 25% to 15%. Korea is supposed to be stepping down the same way, but we still have to ink that deal. The UK, we've got to step down from 25% to 10% with some quotas. So again, it's a mixed bag. We're starting to at least get a little bit more visibility on tariffs, which is a good thing, even though there has been some challenges, certainly in the cost side of the equation to the automakers and some of the key suppliers as it relates to these tariffs. But that begs the question, when you go out to the dealers and you go out to buy these vehicles, yes, vehicles are still very pricey, but incrementally so, we have not seen the cost of the tariffs being borne by the consumer yet. By our estimation, there are three real reasons why, either why or how automakers have been able to do this, kind of participate in this delicate dance and not transmit the costs and the cost of these tariffs directly to the consumer. One way in particular that we've seen automakers use or implement is to really look at pricing holistically on a global perspective, meaning some automakers are taking some price in Asia, taking some price in Europe, certainly taking some price in the North American market, South American market, etc. So it is very much a global exercise. So it means US is not the only area bearing the brunt, as it were. So they're trying to spread the impact. Second way is through decontenting, taking some content out of the vehicles, but not adjusting down the price. So it's sort of a de facto price increase, but moving from maybe leather seats to vinyl or leather to cloth in certain trim levels. That's a big, and then as an offshoot to that, also shifting people to different trim levels in and of themselves. So to really addressing the trim mix and even the segment mix to try to shepherd customers kind of through this purchasing journey to, again, blunt the impacts of these tariffs. The third tool that they're using, or the third, I would say, I guess, lever they have to pull, if you will, is the fact that it was decided earlier on this year by the Trump administration, and they passed by way of working through EPA and NHTSA, they are not charging fines for CAFE violations or missing CAFE targets, fuel economy targets, and automakers are not having to buy regulatory credits. So think of in January of this year, automakers all had a line item in their budget, some sort of emission compliance costs. That bucket of money that was set aside is not being used anymore. So it sort of becomes this fungible kind of funding mechanism to help fill in some of the gaps that we see that are created by tariffs and other things as well. So that's another big consideration. Now, we do tend to think that as you start looking to 2026, you're going to still see some leakage on the pricing side. You're going to see some of this facing the consumer. Now, model year on model year is not uncommon to see prices go up 2 to 3%. So I think that's already kind of a given. That's generally been the case as we transition from one model year to the next. Now, when we look at some of these tariffs, it wouldn't surprise us to see that overall net increase maybe be 5 or 6% or 4 to 5% price increase, including that model year transition. But I'll tell you, early on in all of this tariff strum and drang, there was concerns that that percent, that price hike could have been closer to 9 to 10%. So we're not seeing that. We're seeing certainly a step down from that, but for sure, we do expect to see at least some price escalation as we look to next year. Now, big question we get all the time, and again, because we're forecasting, again, model level and plant level information. So incredibly instructive when you think about, some things you'll hear from the federal government at times, and it's been a little frustrating sometimes in talking to to folks on that in that area, because what the common refrain you heard very early on with these tariffs is, no problem, we'll give the automakers 60 days or 90 days. We'll give them time so that they can bring all that production back to the US. Well, in the auto industry, nothing gets done in 60 or 90 days of that accord. When you're talking about resourcing a plant or a vehicle program, it is a much longer time horizon. Now, with that said, to the broader conversation around what does the capacity look like, this slide takes a look at vehicle production, U.S. vehicle production in blue by major vehicle manufacturer cohort, Detroit 3, Japanese OEMs and the like. And then we've overlaid in gold there, or orange, what the excess capacity is. So to the observation that, well, look, there is excess capacity, that is true. There absolutely is. So there's the ability at some point to be able to bring some of that production back, if you will. The problem is, or the challenge is, some of this capacity is electric vehicle capacity that just simply is being underutilized. It's not easily shiftable or transferable to necessarily internal combustion engine vehicle production, not right away. And then there's just the natural lag. It takes time to bring tooling and equipment online into the US from another market, or to just ramp it up here in the US. So again, there's that timing lag. So the good news in this is it does at least give us some low-hanging fruit. We don't have to do greenfield investment necessarily. Some automakers might, but by the same token, we're not seeing a lot of big plan announcements from a greenfield perspective. Most of this is brownfield, meaning it's existing assets, and then we'll bring that production online. The challenge is that's going to be more of a 2027, 2028 story, which we'll get into in a moment. But there's that natural lag because it takes time to build up the supply chain, get the equipment installed, and moving forward, at least on that, from that perspective. Now let's look at our global light vehicle sales forecast. And what I've done here is I've overlaid our latest October forecast with our March forecast. So think of a pre-tariff forecast versus the latest. And a few interesting things jump right off at the page. First of all, for 2025, our latest forecast for this year is actually a bit higher than where we were in March pre-tariff. Now, some of that is a little better outlook for US sales this year. And again, we were already expecting pretty robust sales this year for the US, that pull ahead effect, if you will. But I'll tell you, so much of this is really predicated on China, that China strength with those EV incentives and the scrappage subsidies, and also strength in some of the other Asia markets as well, the ASEAN market in India. That's really helping to drive some of that outperformance now from where we were before. As you see going forward, we still have a little bit of gap to that pre-tariff number from back in March. And that's because, again, we've got to close a little bit of that gap in the US. We still do expect to see at least a little bit of an impact to consumer demand as it relates to tariffs and the cost of tariffs. And even some of the other international markets still have a little bit of a gap to close due to some of the macro pressures with some of the trade actions that have taken place as well. We do expect to get closer to closing that gap, though, as we get to the latter part of our forecast horizon. So again, the negative impacts of those tariffs have softened somewhat. Some of that softening, frankly, has been just due to the fact that we've seen some adjustments in how the tariffs are being rolled out. Some of those exemptions and some of the trade deals that we have seen have helped to mitigate some of those impacts. And on the production side, we flash it to the other way, and thinking about light vehicle production, similar story starts to play out. Again, 2025 production's outperforming where we were in March. We update our production forecast monthly as an example. And you look over here basically at the data table, you can see it jumps right off the page, Greater China, 32 million units. I mean, it is, a third of global light vehicle production. So as China outperforms, it really does drive a lot of this outperformance for 2025. North America, if you were to look at our pre-tariff number versus now, it's about on par. So we're not necessarily outperforming it a whole lot. It's about even with where we were. But just closing that gap of that immediacy, when we saw the magnitude of the tariffs, at least as they were initially announced, it boded very poorly for the region, especially if we were going to tariff all those USMCA compliant parts. As I mentioned before, not tariffing those parts was huge. That was a big consequential factor. Because think of all the US production alone. If you've got vehicles that are produced in the US, but you're bringing in parts from Canada or Mexico, if we're not tariffing them because they're USMCA compliant, you really are, massively mitigating the impacts of these tariffs. So you're not seeing as much of that negative impact right off the jump. Now we'll get into some of the forecasts as it relates to North America in a moment, but you can see as we look to next year, we do expect it to be about flattish in terms of global light vehicle production. And again, there's some other international markets that are going to be dealing with maybe a little bit of a drawdown, Japan and Korea as an example, a little bit of a step back there in the US, in North America, which we'll touch on in a moment. Again, some of the things impacting production going into next year before we really start to see some of those localization efforts really start to take off in 2027. I'm not going to read all this, a lot of text here, but what I wanted to show here is global light vehicle production by major market. We've got Greater China, North America, Europe, and then there's that proverbial rest of world. Rest of world, when we talk about the growth, that's really going to be the driver of growth for global production. Greater China, for its strength and how massive it is, it's now leaning into much more of a lower growth profile. Again, even though there are still areas within China that are developing, a good part of that market's already developed. So in that sense, it shifts into much more of a lower growth profile mode, if you will. Same thing can even be said for Europe as well. North America, maybe a little bit more growth if you compare it to 2025 as an example, because we've got more of that localization coming. And then that rest of world is really India, the ASEAN markets, ASEAN countries as well, and even South America starting to grow and inflect upward as well. So still some growth from a global light vehicle production perspective, but it's really going to be predicated on the region and dependent on what region we're talking about. And to that end, for anybody who's been following the auto industry, even on a cursory basis, you probably have heard a lot about the Chinese automakers that have been out there. Not so much in terms of how they've been impacting the U.S. market, of course, because there really aren't, BYDs of the world aren't selling here in the U.S., but boy, they're selling everywhere else. And that's been what's fascinating right now. The growth, this just looks at the top 20 automakers as determined by, we call them a sales parent in this case, but these are automakers. Top 20 automakers, 2025 to 2032. And boy, some fascinating things really start to jump off the page. We've got 6 or 7 Chinese manufacturers that are really starting to grow into their own. One of which, the big one, the elephant in the room is BYD. They are going to leapfrog, by our estimation, leapfrog General Motors probably by about 2027, 2028, and enter basically into the top 6 automakers in the world. And a big part of this is not so much these Chinese manufacturers producing in China. Yes, they are producing in China and they're capturing a lot of sales in China, but they're growing outside of China in terms of adding capacity outside of China into Europe, into other Asia, think South Asia in particular, and into South America. I will point out, before anybody asks the question, we don't have them producing in North America yet. Geely is, and Geely's not in this top 20, I'm sorry, they're in top 20 there, but Geely is the owner of Volvo. So there is some Geely production, but in terms of sort of that mainstream production from some of these other Chinese manufacturers, we don't have them in the US yet. My gut tells me it's more of a matter of when, not if. But as it currently stands, we don't have them in the forecast. And admittedly, they've got a lot of irons in the fire right now, so it does feel like they're still kind of working through a lot of their global growth strategies. We're not in the mix quite yet, but it will happen. And again, it's not a case of if it happens, it is when it happens. It's just not in our forecast horizon even as we speak. So let's talk a little bit about the North American and US market right now. US light vehicle sales. And what we've got here is our latest October forecast. And again, I threw in our March forecast just for reference purposes, because we still have a little bit of a gap to close that are impacted and influenced by tariffs. Not this year, though. This year is a strong year. We're at about 16.1 million units. I say strong, and it is. I think that is fair to say. Notice, though, we're still well off the pre-COVID number of 17.1. And in fact, the peak was probably closer to 17.4, going back, I can't remember, it was 2015 or 2016. So we're well off of the peak and the pre-COVID number. And frankly, we think we're going to be well off that for for the foreseeable future. This is a market that's evolved. We've pushed a lot of the entry-level buyers out of the market. For folks on the line who, recall the days of having vehicles like the Ford Taurus and, the Chevy Impala, your passenger cars that were out there, Ford Focus, those are long gone. So as a passenger sedan, if you will, those vehicles have largely exited the market. Yes, we've got some crossover utility vehicles that have slotted in some ways, and certainly they have, but that average pricing profile has definitely escalated. So as we start looking going forward, even into next year, we're at 15.7 million units next year, a step down. Again, we're starting to bake in at least some cost inflation, price inflation as it relates to tariffs. Not as bad as we had previously feared, admittedly. And I think there's some potential for some upside to that 15.7, depending on the assumptions at hand, depending on what the automakers do from a pricing perspective. But our belief at the end of the day is this is becoming, it has become so much more of a question around affordability. Again, so much of that market has been pushed from entry level and entry to mid market, or entry to mainstream market, to more mainstream market and premium. And in doing so, that changes the addressable market. That changes that total industry volume as well. Still in the 16 million unit range, but not quite as lofty as it could be if we were bringing in more buyers that were in the sort of that $20,000 to $30,000 vehicle range. There are some offerings out there, but there are a little fewer and farther between. So we still have some work to do on that front. And to that end, here we take a look at light vehicle sales, U.S. light vehicle sales by vehicle type. And what kind of dovetails on what I mentioned before, this has definitely become less about being a car market and more about being a utility vehicle market, which is blue, and even pickup truck, which is that beige or brown. That pickup truck segment, which is certainly dwarfed by utility vehicle, is still noteworthy because of just the strong pricing and margins that are provided by those pickup trucks. And then, like I said, the blue side of those blue bars are those utility vehicles. Everything from a subcompact crossover utility vehicle to a full-size sport utility vehicle, like say a Tahoe or a Yukon. It's a wide range of offerings. The challenge for the market is that most of those offerings tend to be up there in price. You're talking $40,000, $50,000 on up. It is a little rarer to get some in that 20 to 30,000 or 20 to 40,000 range. There are some, to be sure, and some very popular ones, by the way. The challenge to the industry is some of those vehicles are coming from Korea. Chevy Trax for General Motors is one of their most popular vehicles right now. You can get it for around $22,000 to $28,000 as an entry level or subcompact crossover. Problem is, it's coming from Korea. So now it's currently being tariffed at 25%. Now that should step down to 15%, but those are some of the challenges. Nissan Kicks is another great subcompact crossover offering that comes up from Mexico. So that's getting tariffed at 25% less the US content. So again, some challenges still facing the market, particularly as we try to move in and start to bring in some more of those affordable offerings. So from a production standpoint, interesting trends here. So for anybody who may be on the call that works for a supplier or is, keenly focused on the supplier side of the business, suppliers get paid on vehicles that are produced because they're producing parts for those vehicles. Yes, sales are important, of course, but from a production perspective, we've run through the gamut here. During COVID and those supply chain shortages, we had a couple of years at 13 million units of production. By way of reference, in 2016, we peaked at 17.8. So you can imagine from a supplier perspective, that's a stark fall off. Even heck, it's a big fall off even from the pre-COVID number of 16.3. Now we've been building our way back. This year, 2025, we do take a little bit of a step back, 15.1 million units. Now, some of this is being impacted by way of, for folks who've been kind of following the news, we had that plant fire at Novelis. They're an aluminum provider that's impacted Ford and some other automakers. So you have some just non-tariff related impacts, but there's also some tariff related influences there as well. Next year, I mentioned this previously, we're at 14.7, a little bit of a step down. Again, there are some levers to maybe see that number go up a bit. What's the tariff pricing strategy on the part of the automakers? Do they really step back from that even more and really just kind of flatline pricing? They haven't generally indicated they're going to do that necessarily. We don't think they're going to be pricing in the full effect of these tariffs, but If we see them, incentivize a bit more, build up a bit more inventory, some of those things can certainly support that. But by by way of looking at at least our base case scenario, we still see some pressure on production going into next year. Then you go up to 27 and 28, and that's when we start to build back. We've got more localization coming on board. Some of this is tariff related, and some of it's even beyond tariff related, frankly. We see some other influences too. Just there was going to be that natural localization activity that we've been seeing kind of play out in the market. So we do see the market from a North American production perspective getting closer to 16.5 million units, which I'd say is still pretty positive for the industry. We look at North American production by automaker type, Detroit 3 versus EV players in blue, and then those transplants. Those are just general foreign automakers operating here, Toyota, Honda, Nissan. Interesting thing here is back in 2019 was the first year we actually had parity between the foreign automakers and the Detroit 3. So fascinating to see there because it was majority production for the D3 before then. Flash forward to now, we're starting to see some distance between the two parties. Those foreign automakers are bringing on more production here, driving more of that production up, and the Detroit 3 are kind of coalescing around the mid to upper 6 million unit range as we see it towards the end of our forecast horizon. The good news there, I know you can look at it and say going from 8 million in 2019 to 6.7, 6.8 is a little bit stark, but that's also, bear in mind, very profitable production as well. So it's not necessarily meant to be a bad news story for the Detroit 3. We're looking at profitable truck and utility vehicle production, which is certainly a good thing in our estimation for those automakers. Again, for anybody who's particularly looking at suppliers, here we take a look at vehicle launches. So this is just model count, kind of. Forget about volumes. These are models. Any model that's being launched that's an all new or a major redesign. So anything that kicks off a new program code creates a sort of a quotable event for a supplier. And it's a real good way for a supplier to build out that book of business, as you can imagine. And a fascinating thing has occurred over the last 18 months. If you look at this slide 18 months ago, 2024 to 2027 would have been right around 35-ish vehicle launches a year. Pretty steady, almost too steady. And indeed, what we've seen since then, we've seen tariffs, obviously, but we've seen this sort of EV disruption in a negative way, meaning EVs really haven't taken off. We've got a new administration in here. We've pulled the EV incentives now. It's forced kind of sort of a rescoping across the board. Automakers have delayed some programs, they've canceled other programs, and they've extended existing vehicles that are on the road, extended those programs, and that's effectively pushed out some of these launches to 28 and 29. Now we could see some of those slide forward a bit, but we could also see some of those 28 and 29 launches actually slip out further as well. So it creates more uncertainty, a little more volatility, certainly for the supply chain in particular, as they try to navigate these new vehicle launches coming down the pike. Let's talk about EVs a little bit. Where do we see the market going from an EV perspective? And it really has been disrupted here. And we could call it disruption. We could call it that, the consumer has spoken, whatever we want to call it. What we look at here is a normal distribution, and then what we've overlaid is the Gartner hype cycle, just to kind of put in sort of graphical terms where we think we are in this journey on the electric vehicle. We've gone through a lot. We've brought in innovators. Those early adopters have largely entered the market from an EV perspective. Some of them have been supported by EV incentives. Some of them have been supported by, they love the whole product proposition of an electric vehicle, the use case, how you can use them and interact with them at any given point. The challenge is, as an industry, we've been capacitizing towards this mainstream part of the market. We've expanded capacity massively, and yet we're kind of stuck in this chasm. We're in this disconnect where consumers haven't quite entered in to joining the journey, if you will, in the mainstream. We've got challenges around still lingering on the affordability side, although we're closing some of that gap. We're bringing more affordable vehicles out. But charging is a big one. Range anxiety remains something of a problem, not so much as the effective range, because we're seeing 250, 300 miles range coming in, and that's sort of in the sweet spot, but it's all coming back to charging. And that's really what we see. We do a lot of work with polling and doing consumer surveys, and something fascinating has really kind of transpired over the last few years. You go back to a survey we did back in 2021, and this is looking at basically hand raisers. Are you open to purchasing an electric vehicle? I'll focus on the electric here in orange. And in 2021, we had a lot of hand raisers. 81% said, yeah, we're open to an electric vehicle. And I think, and we can try to create a narrative around why this happened. Maybe it's as the electric vehicles became more tangible, and it's like, okay, now we're actually being told or asked to put our money on the line or commit to it. We've seen some reluctance. We've seen those hand raisers start to maybe pull their hand down a bit. Now we're at 52, 56%. So there's some tangible reluctance to engage on the EV side, at least on that front. And there's a multitude of reasons. We still think charging infrastructure is a big factor here. We have 150,000 gas stations all around the US. We all know where they are locally. We know the corner gas station, and there's multiple of them. If we're going on a long trip, we know we're going to find one at an exit. So there's certainly more comfort around that than there is around the availability and the charging infrastructure that's out there amongst most buyers or many of the mainstream part of the market. The automakers are working through this education process. We get people thinking about, if you have a garage, effectively you could have a gas station in your garage to refuel that EV. And that's absolutely true, and we see that playing out every day. But we still have a lot of work to really build that charging infrastructure. It's a work in process, to be sure, and we're making some strides, but not enough to really kind of lean into that full mainstream adoption. And that's why it's going to take a little bit more time by our estimation. And as a result, one of the things that we've been tracking closely, and it sort of dovetails in with those vehicle redesigns I mentioned earlier, battery electric vehicle launches have gone through a big shakeup, if you will. Here we take a look at our latest September forecast for vehicle launches for battery electric versus our September forecast of last year. And what this shows is we've had about 27 launch delays, some very significant, some not as so. And I know this isn't terribly readable, and it's not really meant to be. It's really looking at focusing your eyes on that y-axis and all those vehicle programs basically showing delays to the right of the axis. So a number of vehicle programs that are being pushed out, being rescoped, reprioritized, and totally understand why on the part of the automakers. Again, if consumer adoption isn't quite where it needs to be, you might have to rethink some things or rescope some things. We've also had about 66 program cancellations through our forecast horizon that certainly have been influencing that as well. And in concert with that, the flip side, and I alluded to this earlier, internal combustion engine vehicles, we've seen a lot of program extensions, meaning the vehicle was going to end production, say, next year, and the automaker says, we're going to make it end the following year. We're going to keep it going a bit longer, so we don't have to spend the money to redesign it right away. We're going to buy ourselves some time. And that can have benefits for both an automaker and some suppliers. If you're a supplier and you're making money on that program and they run it back another year, okay, that can be good. The challenge is that's been a little bit more fewer and farther between. More often than not, that might be a vehicle program that's been under production for 6 years. You've had 6 years of cost downs. You've got a 6-year-old tooling, and now you're being told, run it back for 2 more years. Supplier has to have some conversations maybe with the automaker. Say, look, we need to get that tooling refurbished. We may need to look at the economics because some things have changed. A lot's changed if you think about it in 6 years. Inflation, all of the things that can kind of influence business cases have really changed radically since 2019, as an example. So there's a lot of things going on, at least on that front, on the part of suppliers and automakers to kind of navigate these internal combustion engine vehicle extensions. But it is going on. We're seeing it really very much impacting the market. This is one of my last slides, and we'll open it up for some Q&A, but I think it's instructive to show kind of where we're at here and why we're not fully out of the woods yet as it relates to the battery electric vehicle dislocation that's out there. I'm trying to think of the most euphemistic way to talk about it, but it is what it is. Left-hand side of the slide, we look at battery electric vehicle production in North America, and that's the line chart. And you can see over the next couple of years, it's going to be about flattish. We're going to be going through the fact that the BEV incentives are gone. We're going to start to lean into some more vehicle launches, and we do think they're going to come. And we've got some certainly volume growth, and it can look pretty stark. I mean, it's pretty solid production growth. Realize that by 2030, when we show about 2.6 or 2.7 million units of production in battery electric, That's a marked down. I mean, we have reduced that rather significantly, but we do see continued development on charging infrastructure. We do see some of these vehicle programs certainly coming to fruition. The bar charts are actual model count. So those are the battery electric vehicle model count. And that's what translates us to the right-hand side of the slide. And that's volume per nameplate. So again, if you're in a supplier or supporting a supplier or affiliated with a supplier, this is where the rubber hits the road for the supplier. That's volume. So your average internal combustion engine vehicle has volume per nameplate of 85,000 to 95,000 units per nameplate per year. Think of the Silverado, the Ford F-Series, the Dodge Ram pickup truck. Those vehicles definitely transact and sell at more than 85,000 to 95,000 units per year. Certainly, there are some other ICE vehicles that are below that, but averaging out 85K to 95K. In 2019, from a battery electric vehicle perspective, we got close to 70,000 units per nameplate. So it's not nothing. That's good, close. But look at over here on the left-hand side. That was only on 6 models. And most of them that were consequential were Tesla. Not, it's just showing that it was a very concentrated group. Flash forward to this year, and even in going into next year, when you start harmonizing all of the models that are battery electric vehicle with the volumes that are being forecasted, we're stuck kind of in the mud of between 20,000 to 30,000 units per nameplate per year. So for a supplier that builds tens of thousands or hundreds of thousands of parts per year, that can be jarring. That's going to be something that suppliers are going to continue to have to navigate as they think about really kind of scoping out their lines, outfitting and capacitizing for these programs, maybe engaging in more flexibility to the extent they can to try to mitigate the impacts of that, because there is still maybe a bit more pain to come, at least on that front. And again, my last slide here, just looking at electric vehicle, and more than that, sales from a sales perspective, Europe, US, mainland China, and rest of world, sales by propulsion type. And electric vehicles are in red there with the black numbers call out there. And you can look at US. This year, we're at about 9% take rate for battery electric. It's about on par with last year, maybe a little bit of a tick up. And that's going to be a little bit of a lift. We're going to have some work ahead of us. We had a really strong September because those EV incentives were winding down. The challenge is, as you go to October through December, we don't have the EV incentives. So there is going to be a payback there. More importantly, you look to 2030, we're at 17%. And again, you could look at that glass half full or half empty. On the one hand, we have pulled down our expectations on BEV penetration in the US significantly, but that 17% is still going to require some work on charging infrastructure, work on affordability, more affordable models. And there is likely some risk to that number, where we could see certainly a few points potentially being shaved off that, depending on what happens on the part of automakers and their execution strategy and what we do in terms of infrastructure. Certainly some downside risk there. Europe, different position relative to the US. Again, 19% adoption this year, far cry from where we are in the US, and growing to 41% by 2030. So different than the US, but it's starting to resemble a little bit of the US because there has been some pushback, some pressure on the part of consumers there too. Certainly they are selling more, but as you go into some of the southern European countries and even some of the central European countries, it's getting a little harder. It's a little harder to engage the consumer on that front. Now, some of those lower cost Chinese EVs have come into the market, and those have helped certainly to consummate some sales, and that has helped. But the broader emissions requirements in Europe are really dictating a far higher penetration rate for battery electric vehicles. So if you look at our forecast for 2030 and 2035, just realize we're forecasting an out of compliance situation in Europe to the emission standards as they currently exist. So that's saying something in its own right. There's going to be some more work to do from a country and a region perspective, at least on that front, because the consumer base, by our estimation, is not going to be quite in that same frame of mind. Mainland China is really different than both those other regions, US and Europe. Much further along in terms of EV adoption, much more focused on encouraging both EV and plug-in hybrid. Plug-in hybrid is in the black bar there. But even so, again, I alluded to this earlier, there are still elements of China that are still kind of very, very emerging markets. So they've got more EV charging infrastructure development to do. They've got more push to go inland. And we do see that happening. But again, when you see 51% adoption in 2030, remember, that's on a 30 plus million unit production base. So that's a lot of EVs that are be coursing through the market in China. And that doesn't even factor in the plug-in hybrids in the represented by the black bar just above it as well. So some pretty healthy electrification coming down the pike in mainland China.